Welcome. If you're a federal employee or service member nearing retirement or considering leaving the government, this program is for you. The U.S. Securities and Exchange Commission is once again teaming up with the Federal Retirement Thrift Investment Board, that's the agency that runs the TSP, and we're going to discuss important considerations for your retirement account. I'm Tom Manganello from the SEC's Office of Investor Education and Advocacy. This annual collaboration has become popular over the past decade because it gives federal employees up-to-date guidance as they consider their finances before starting their life's next chapter, whether that's retirement or private sector employment. We thank you for joining us, and we thank our friends at the Office of Personnel Management for sharing this program with agencies across the federal government and military. And here's what we'll cover in the next 45-plus minutes. Randy Urban is going to tell you about new features in your TSP account and give you a refresher on the core TSP investment funds. And you'll hear about how to manage your account after separation, and then Randy will go over your post-service distribution options. On behalf of the SEC, we'll have a brief refresher on investing principles, including the benefits of tax-advantaged investments, how your money can grow through compounding, and how to manage the risk of investing. We'll then go over some of your options when you leave the federal government or military. And we're going to close with tips on how to protect your investments from scams and introduce you to some of the free resources that can help you be a more informed investor. One of those important resources is the SEC's website for investors, Investor.gov. This is the landing page of Investor.gov, and this site is worth bookmarking on your phone. This QR code will take you right there. And if you're in the military or a veteran in the armed forces, we have customized pages under the tab that says Additional Resources, where you see the right red arrow. And if you'd like to dive deeper into some of the retirement content we'll cover today, check out the Resources for Older Investors tab under the center red arrow. Investor.gov has many useful tools and resources, including our alerts and bulletins to keep you up to date on investment products, trends, and scams facing investors. We also have our popular required minimum distribution calculator, as well as our compound interest and savings goal calculators. And of course, our Check Out Your Investment Professional tool allows you to verify if you're dealing with a licensed, registered investment professional and to see their work history and any red flags they may have in their past. And so let's begin. I'm required to share this disclaimer. It essentially states that we won't be providing legal advice or investment advice today. The views that I express are my own, not necessarily the views of the Securities and Exchange Commission, its commissioners, or staff. And now let me introduce Randy Urban from the Federal Retirement Thrift Investment Board, who has a disclaimer of his own.
Hi, I'm Randy Urban from the Federal Retirement Thrift Investment Board, or FRTIB for short. I work as a TSP Training and Liaison Specialist in the Training and Liaison branch. Just a quick reminder, the disclaimer, I cannot give any kind of advice. I cannot endorse or promote any products, services, or third parties. During this TSP discussion, I'm going to give you some helpful information so that you can make better decisions with your TSP. I'd also like to discuss some upcoming changes in the year 2026. So very soon, there'll be some new options and changes with your TSP. I'm also going to go into the investment funds, the core funds. We have 16 core funds. I'm going to go into that just a little bit here today. And then eventually we'll get into what your options are when you separate from service, your post-service distribution options. Along the way, I'm going to also remind you of resources to further educate yourself on your TSP and make good decisions with your TSP. I do want to remind everyone, especially with everything that's going on this year, of the status of a TSP participants. And what I mean by that is all TSP participants are either active or separated. So you're either in service or post-service. Of course, as you can see on the slide, you're always managing your TSP account. So you're always managing your TSP investments. There's a few areas of the plan I won't be going over today. The loan program, the two in-service withdrawal options that you have, And we won't be diving into the TSP death benefits, but there's plenty of information on our website at TSP.gov for you to follow up on those areas. But like I said, I want to remind everyone that you're either active or separated. Now, when I say that, we find out in the TSP record-keeping system that you actually officially separated about a pay period or two after you officially separate. We receive a separation code for your account. So I want to urge everyone to become very familiar with accessing your account at TSP.gov. When you do log in, if you look in the top right-hand corner, you'll see an icon you can click on. That's your profile for your TSP account. We rely heavily on your agency payroll offices, whether that's a service or agency payroll office, to provide that information for us for your profile. So you want to take a look at that every now and then to make sure we have correct information. Now, you can add alternate mailing addresses, email addresses, and of course, when you separate from service, you'll give us follow-up information on that. So one area I want to discuss, of course, is one of the big selling points of TSP over the years, and that's the low cost of the plan. We express this as a TSP expense ratio. So your total expense ratio for 2024 was 0.039% or 39 cents for every $1,000 you had invested. Now, where do you find out information about the expenses of the plan, additional fees for the loan program, and other expenses? You'd find that out on our website under Manage Your Plan. There's a TSP Basics section for that. Now, you'll also see a little bit of this information on your annual statements. What I do want to remind everyone is that you're commingled in all of the core funds with your fellow TSP participants. What that means is that you're not going to see a specific expense to you on your statement or your account. What you're looking at is the share prices. We are a share-based plan, so the overall value of your TSP account based on the share prices is really the reflection of the cost to you for your TSP account. I've gone a little bit deeper into one of the funds, one of the core funds, the C fund, our large equity fund. That was 0.036% last year, so slightly less in cost. And once again, you're sharing in the cost of the overall plan with your fellow TSP participants. Now, I do want to go over a few changes, as I mentioned, that are going to be happening next year in 2026. First, Roth in-plan conversions. Now, I've answered these questions for many years as to when we were going to implement this. So now the answer is yes, it's coming, and it's going to start next year. I'm not going to dive into this too much, but what this essentially does is it allows you to move or transfer traditional funds already in your account over to the Roth side. So that will be starting next year. Now, a few things about that. Keep in mind that you're going to be sort of on the hook for the estimated taxes up front because you're transferring funds from the traditional to the Roth side of your account. So it is a tax decision also that's going to be coming into play with that. I won't dive into the 5-year rule for this too much other than to say that it'll be slightly different and will restart for the in-plan conversion portions of your account as opposed to the regular Roth contributions in your account. The other change that's upcoming next year would be the catch-up contributions as Roth. And what this means is, starting next year, based off your federal wages from the previous year, now, if that were to occur this year, the number they're working with now is $145,000. That will be updated for next year, so we'll see what that number is for next year. The good news with this is that you don't have to do anything. It will automatically convert your catch-up contributions if you're eligible later in the year as you're making those catch-up contributions into Roth contributions. So there's nothing you have to do as a participant for this. So if this does apply to you, it'll automatically occur. Now, I don't want to get too far into the weeds on that one either, but it's a little bit more nuanced than that. If you do contribute to your account as Roth earlier in the year, then that will come into play to satisfy this new rule for catch-up contributions as Roth. So this is another area of changes that you'll find more and more information on our website at TSP.gov. And of course, we'll roll out more of that information throughout the rest of this year and into 2026. So let's talk about those funds a little bit more here today. You're always investing and managing those investments in your TSP account. So what is happening with TSP? We have 16 core funds, we have 5 individual funds, and then we have 11 life cycle or L-Funds that are target date funds. I'll come back to those in just a moment. But as you're investing in the individual funds, there's a benchmark for each one of the funds outside of the G fund. That benchmark is how those funds are invested out in the various markets. So an index investment fund is simply just a list of something, and that's how the investments are made out in those markets. The whole point behind diversification, of course, is to lower risk, increase potential gains, and improve the overall value of your account. So improving those share prices within your TSP. So we have 5 individual funds that you can create a portfolio on your own if you want to. I'll get to the L-Funds in just a moment, but when we get to the L-Funds, each one of those L-Funds is a combination of the 5 individual funds you see on the slide. And that kind of creates a portfolio, if you will. So from left to right on the slide, you're looking at the 3 stock funds, CS and I. That would be a more aggressive approach if you're leaning towards the CS and I, or you're simply using the CS and I as your investments. There are 2 more fixed income funds with the F and the G, the F fund being a bond fund. And you can see that each one of these outside of the G fund has a benchmark, and that is how, once again, the funds are invested out in those markets. So the C fund, being our large equity fund, is tracking the S&P 500. The S fund is a completion index, and what that really means is that it doesn't include the S&P 500, but includes almost everything outside of that traded in the U.S. markets. It doesn't include penny stocks and some of those types of investments. So the S fund combined with the C fund gives you exposure or investments to cover small, medium, and large size equities traded in the U.S. market. Now, right down the middle, you see the I fund, which is international, and we went through a bit of a change. I'm going to follow up on that on the next slide with some more detail, but we did change the benchmark last year. We transitioned to a new benchmark, which actually includes emerging markets in addition to the developed markets. Now, also, while I'm going through all of these stock funds, you're dealing with market risk, you're dealing with currency risk in your I fund. So keep that in mind. Those are the things that affect the investments, the performance of those funds. Now, the F fund, being a bond fund, is sort of in between that G fund and the 3 stock funds. There's no junk bonds in this. This is all BBB rated and above. In fact, most of this is AAA rated in the F fund. It's a little bit less volatile than your 3 stock funds. Maybe not as aggressive, and you're not going to have as high gains at times in the F fund, but it gives you further ability to diversify your portfolio in your TSP. And then, of course, there's the G fund, the good old safe G fund that we manage in-house at the board. While there's no risk of loss on principal in the G fund, there is risk of those funds not keeping up with inflation and taxes. So typically a participant is leaning more towards the stock funds, the CS&I, the further out their target date or time horizons are. So that's the 5 individual funds. And let me just further elaborate on the I fund. As I mentioned a moment ago, we went through a transition. The benchmark now includes 44 markets outside of the U.S. It does not include the United States markets. It does not include China or Hong Kong. The benchmark swapped out Hong Kong for Canada as a developed market. So there's 21 developed markets and 23 emerging markets. Now, it's a very large index, so it's over 5,500. So there's a little work that has to be done to do representative samples of the smaller equities in this I fund. So that's been a big change that happened last year. So as a matter of fact, to this date, the I fund is one of the best, if not the best performer. I think it is still the best performer year to date in the 3 stock funds in TSP as of this recording. So that's the new I fund benchmark. So we can go to the L-Funds. I mentioned a moment ago that the L-Funds are all simply a combination of those 5 individual funds. So it gives you that portfolio. Now, these are target date funds in 5-year increments. Participants, if you've come on board in recent years, now default, both our service members and civilians, to the age-appropriate L-Fund. So if you've done nothing since you came on board in recent years, that's how you're investing in your TSP account. And I'm going to show you in a few slides how you can make changes to those investments. So we currently have 5-year increments all the way up to the year 2075. All of these funds are actually automatically reallocating towards conservative. So when we're talking about TSP, that means towards the G fund. Every quarter it reallocates towards the G fund, a little bit of the F fund, but mostly to the G fund. Now they're all eventually working their way to become the L income fund, which is for those participants that are at retirement, using their funds, or very close to doing so. Now, I do want to throw out another idea before we move on from the L funds, and that's the term time horizon. These are target date funds, but your actual time horizon, when you think you're going to start using the funds in your TSP, might be different. So you might consider using that as your guide. Now, you can use the L funds. You can use one of the L funds, multiple L funds. We see all kinds of combinations. And of course, we mentioned the individual funds if you want to create your own portfolio. So once again, what's happening with the L funds is you're moving from that higher risk, higher reward potential down to a more conservative portfolio that's automatically happening with your account. And the easiest way to really remember the L funds is that the further out the date, the more you're going to have in the 3 stock funds, CS&I, and the longer you're going to stay that way. And the incremental changes will slowly move towards conservative. So I mentioned there's a few ways you can change your investments. Now, this is one of the many new ways that you go into your TSP account, log in at TSP.gov, and you conduct business with your TSP. Many of the old processes are now electronic. When you do log into your account, you'll see a strip or a banner that goes across the screen there. And one of those options is change investments. So this is the way you tell us if you want to change how your future or new money coming into your account is invested in your account, or maybe even move the current or existing funds around in your account. So the investment election, we all have one investment election on file all the time. It's simply sitting there waiting for funds to come in, and that tells us how you want to invest. And that controls or is applied to all of the funds coming into your account, whether that's your contributions, the agency of service money, the matching, and so on. Now, the other two you see there, the fund reallocation and the fund transfer, those are 2 ways that you can move your existing balances around. The fund reallocation allows you to use whole percentages that add up to your whole account, 100%, so you're affecting the whole account. The fund transfer is relatively new, and it now allows you to be more specific. So if you want to move from one or more funds to one or more funds, then that is your option you can use. Now, I do want to remind everyone there are some rules to follow here. There's a limit of 2 per month, so you can use any combination of the fund reallocations and the fund transfers twice every month. After that, you still have the old safe haven rule to move back to the G fund. And there's also a cutoff time during business days for this to occur. So if you submit a fund reallocation or a fund transfer before 12 noon Eastern time on business days, it will be effective that day ordinarily. All right, so now we're going to move into your options and a discussion of what you can do after you separate from service. And I do want to remind folks that we don't know you're separated until we receive that separation code from your agency or service, which generally happens about a pay period or two after you officially separate from service. They're always managing that account once again. And I do want to point out one factor there. You see on the slide, the $200. So oftentimes I get asked questions about whether a participant can move funds back into their account. Maybe you separated from service, whether you're going on to work somewhere else or you're truly retiring. Of course, that is up to you. But oftentimes I'll get asked questions about whether I can move my funds from another plan. Maybe you moved them into a 401k or a traditional IRA, something we can accept back into TSP as a rollover in, and whether or not you can move those funds back in. And the simple rule here is if you separate from service and you zero out your account, then you simply don't have a plan to come back to, so the answer would be no. Now, if you do separate from service and you maintain at least a very minimum balance of $200, then the answer would be yes, you still have an account to come back to. So keep that in mind when you're considering potentially moving funds out of TSP into other plans. But once again, let me remind you, the low cost of TSP and your TSP expenses are pretty much lower than about over 99% of other plans out there. So as we discuss the post-service withdrawal options, or what we now refer to as distributions, keep in mind there are no rules that require you to take your funds out of your TSP if you've heard anything to that effect. The only rule that exists would be the required minimum distribution rules. Now, these are IRS rules that apply to various types of plans, and for your TSP, that requirement doesn't start until you're age 73. As you can see, they already plan to change this to 75 in the year 2033, and you're separated from your federal job. So for your TSP, because this is TSP, your federal job separated from that job. Now, if you're still working at those ages, this does not apply to you until you finally do separate from service as a federal employee. Now, the other change that's taken place recently is we now only use your traditional balance. That is the traditional balance to calculate the RMD amounts, and what you're taking from, withdrawing from the traditional balance will satisfy the RMD rules. And simply put, this is IRS saying you must withdraw and receive a minimum distribution each year. Now, the first year is your first distribution year. They give you a window into the second year until April 1st. And then each year after that, in subsequent years, you have to satisfy it by the end of each year. Now, that's, of course, if you still have traditional funds in your account and you are still separated from your federal position. So let's talk about what those options are. With all the big changes that have happened in recent years, these have pretty much stayed the same. You have a partial distribution option, which allows you to take out a lump sum every now and then if you want to. That's a one-time event. Of course, participants can always take out their whole account, a total distribution. That's certainly an option there. And many of you will start installment payments to supplement other sources of income in your retirement years. You can set these up as monthly, quarterly, or annual statements. You can change the amounts. You can start these. You can stop and restart the installment payments. So they're very flexible to fit what your needs might be in your retirement years. We do also still have a life annuity, which you can use for part of your account, or if it's a smaller account, maybe even the whole account. This is through MetLife. It's contracted through MetLife, and the money would leave TSP and you would deal directly with MetLife for this life annuity. So as I'm going through these various options, you can mix and match these. You might take out the occasional partial distribution and do nothing at all. You may set up a series of installment payments and then occasionally take out a partial distribution for other expenses. You may even add the life annuity with part of your account. One of the options with the life annuity allows you to do a joint life with a spouse or maybe a dependent child or adult. So that might be a consideration for part of your account if you want to. So there are lots of options, and that's really what I want to get across here, is that you have flexible options to use for your TSP account when you go to withdraw from your account in post-service. All right, so I also want to remind everyone that with your in-service withdrawals, which we didn't dive into here today, but also your post-service distributions or your post-service withdrawals, you can target, if you have both traditional and Roth funds in your account, you can choose to target the traditional or Roth funds first. You can certainly stick with the old pro rata proportional rule and just have those funds come out from each side proportionally. Now, these are also some of the questions you'll answer electronically when you're inside your account. And as I mentioned before, with the change investments, this is another area you simply look for withdrawals. I think if I remember correctly, it says withdrawals and rollovers out. So you'll look for that section, and you simply go into that section and you'll follow the prompts and fill out the information online. So you're not looking for paper forms or numbered forms anymore. You're conducting business electronically within your TSP account. One very important resource we have on our website, if you've been around for a while, you might remember we used to have a series of tax notices. We combine those into one large book called Tax Rules About Your TSP Account. It's a very important booklet right up there with our summary of our plan. Now, all of our booklets, fact sheets, any of those types of resources, you can locate those on our website. Just simply put in TSP.gov/forms. It takes you right to that forms and resources section. Now, the reason I'm highlighting this booklet is because it does dive into tax rules, tax reporting, tax withholding, which I'm going to talk about a little bit in the next few slides. It also has some very important bits of information regarding the various exceptions to the IRS early withdrawal penalty. On page 19, there's a very important chart that lists all the ways you take payments out of your TSP account, and it allows you to get the answers to whether you can roll over that type of payment to another plan, what are the tax withholding amounts and rules for that type of payment. And once again, I'll talk about that a little bit in the next slide. There's also sections to dive deeper into the RMD rules, which I just touched on for a moment there. The larger IRS charts or tables for single life and the uniform lifetime table are also in this booklet, and those are the tables used to calculate for some of the options for installment payments and even the RMD rules and the RMD calculations. So as I mentioned a moment ago, tax reporting and withholding. These are important terms to understand as you're making decisions. We can't tell you exactly what you're going to owe in taxes when you take funds out of your account, but we do report on a federal level. We also report on a state level. So you will receive that 1099-R from us when you take funds out, and you will use that to file your taxes. Now, we only withhold on a federal level. Although we do report to states with a state income tax, we don't withhold for those states. That'll be on you for that. But we do withhold on a federal level. And keep in mind, federal tax withholding is not taxes owed. It is meant to cover you for potential taxes that you will owe. And this gets back to that chart in the tax rules booklet on page 19, which gives you the answers to, well, can I increase tax withholding? In almost every case, you can do that. Can I decrease or waive withholding from that type of payment? In some cases, the answer is yes, you can. So keep that in mind when you're making your decisions to withdraw from your account, the effect of federal tax withholding on those amounts that you're taking out. Now, they might withhold more than you owe, and you'll get a refund for that when you file your taxes. But keep that in mind as you're making your decisions for withdrawals and the effect of tax withholding. So the exceptions to that early withdrawal penalty. Now, I'm not going to go over all the exceptions. There's about 15 that could apply, and that full list is in the tax rules booklet. You can also go to IRS's website for that. I'm going to highlight about 5 of those here that are very specific, related to your TSP account. Of course, at age 59 and a half or older, there is no early withdrawal penalty of 10%. So that goes away completely. That's the first exception. The second one would be when you work into the year you turn 55, and this is for all of us, all federal employees. If you work into the year you turn 55 as a federal employee, you separate from service and you start to withdraw, you will not have that early withdrawal penalty. So that is for all of us. And that sort of covers all those MRAs and those types of separation circumstances. Now, a few years ago, or a little more than a few years ago, they changed the rule as it applies to public safety employees. And they lowered it down to the age of 50. So same thing goes. If you work into the year you turn 50, you separate from service, you start to withdraw, no penalty. Now, public safety employees, meaning law enforcement, firefighters, air traffic controllers, customs agents, they're law enforcement. And then, as you can see on the slide there, they came along a few years ago with Secure 2.0, and they added a caveat to that. So 25 years of service as a public safety employee, regardless of age, also would be an exception to that early withdrawal penalty. Now, the last two on the list on the slide there are directly related to your TSP. You can choose to let the system calculate payments for you for the installment payments using the IRS life expectancy table. Now, this is an exception, and this is something that a person at a younger age might consider if they really need to touch in and tap into their TSP funds after they separate from service at a younger age. So it does give you the exception, but I'm going to follow up on that with a caveat on the next slide. Now, as I mentioned earlier, there's also that life annuity through MetLife. If you choose to use part of your account for that, they're not going to penalize you for choosing that either. So the caveat I'm referring to here, and this is really important, especially younger folks leaving, separating, maybe, like I said, you do have to touch the funds. If you choose to let the system calculate the payments for you, you avoid the penalty, you'll still deal with any taxes, and that's a good thing overall. But the rule here is that you have to stick with it for a period of time, at least 5 years, or turning the age of 59 and a half. So 5 years or turning the age of 59 and a half. So that means you can't stop or change the payment amounts. You can't take out additional payments. You have to stick with it for a period of time in order to avoid any additional penalties. And that would be a penalty going forward and a retroactive penalty for that. So as I wrap up the TSP section here, remind you of the TSP resources we have. Of course, there's the website at TSP.gov. We have webinars that we conduct regularly throughout the year. So simply put in TSP.gov/webinars. We use Microsoft Teams. Those are free, open to the public, and you don't even have to register for the sessions. So take a look at our online learning section on our website. There's also the TSP Thrift line, the phone line, and the new TSP mobile app where you can conduct business with your TSP. And that's it for the TSP section. Now back to you, Tom.
Thank you, Randy. Now we want to step back and take a broader look at your overall portfolio and how you are considering important concepts like the risk of your investments, the fees you're paying, and how you can protect your nest egg from fraud. We can't recommend specific investments, but as you move through your federal or military career, keep in mind that certain investments offer advantages like tax breaks, matches, and the ability to diversify your portfolio. Because these are desirable attributes in an investment, that probably explains why many federal employees and active duty military make the TSP their first building block of investing. TSP comes with two unique advantages. Your contributions give you tax breaks, and the federal government offers a match up to 5%, which is free additional compensation as long as you contribute at least 5%. Contributions to a 401k like the TSP must come from payroll, and you keep these funds even if you change jobs. Another tax-advantaged way to build wealth is individual retirement accounts or an IRA. This is an investment you can set up yourself and contribute to regularly. Hundreds of investment companies, brokerages, banks, credit unions, even apps will allow you to set up an IRA. You go to their website, you fill out the digital paperwork, and you open up the IRA. And remember that non-working spouses and children with jobs with W-2 income can also contribute to an IRA. Now keep in mind, you can put a lot of money into these building block investments. You can put up to $23,500 in your employer-sponsored plan, and for us, that's of course the TSP. And if you have an IRA, you can contribute $7,000 annually. In both cases, if you're over the age of 50, you can make what are called catch-up contributions, and employees between 60 and 63 can contribute $11,250 additional dollars as a result of Secure Act 2.0. Now, these numbers may go up in 2026, so consult your HR department or visit TSP.gov if you plan to max out your contributions. Now, the type of tax break you get with retirement accounts like the TSP depends on whether you contribute traditionally or through Roth. With a traditional option, that's a tax break now, tax hit later, you are going to lower your current year's taxable income by the amount of your contribution, and the money will grow tax-free until you begin taking distributions in retirement. When you withdraw funds, they will be taxed at your income tax rate at the time. With a Roth option, it's exactly the opposite, right? Tax hit now, tax break later. You'll contribute after-tax money. In other words, you will be taxed now at your current tax rate, but then the funds will grow tax-free and face no future taxation. There are tens of thousands of federal employees and military personnel who are TSP millionaires as of this summer. In other words, they had TSP account balances over $1 million. Now, did they get rich quickly? No. Instead, they probably put in place a system of making regular contributions, and they stuck to it over a long period of time. First, they probably signed up for TSP as soon as they could, and they contributed as much as they could afford throughout their career, many of them all the way up to that IRS maximum each year. They also took advantage of any employer matches for contributions. That allowed them to build wealth that much faster. They contributed consistently, whether markets were up or down throughout their decades of working, and they invested in a strategy that was appropriate for their time horizon. In the earlier years of their career, that probably meant investing in stocks and taking on more risk in exchange for more potential return over time. And for those of us who like that set it and forget it investment strategy, they probably chose the life cycle fund that corresponded to their likely retirement year. Now, how long would it take us to reach $500,000? Well, the earlier we start investing, the easier it is to reach that goal. For example, an 18-year-old soldier in basic training only has to put about $127 per month into the TSP to reach that goal by the age of 65. The longer we wait to begin investing, of course, the more money we would have to contribute to reach that goal. This graph presumes, of course, that we're starting from zero. Some of us may already have some investments in the TSP. In fact, according to the TSP, the average account balance is around $139,000. So if you started with that average balance, here's the amount you would need to invest each month to reach $500,000 by age 65. Start at age 45, and you could probably get there pretty easily on the strength of your growth alone, assuming an average annual return of 7%. Wait until the age of 50, and you would need to invest about $387 per month. Wait another 5 years, you're now up to nearly $1,400 per month. And of course, if you leave yourself only 5 years to close the gap, you'd have to invest more than $4,400 per month. Now, your goal may be different, both the amount you want to have in retirement and the age that you want to stop working. You can do your own customized calculation using the Savings Goal Calculator on Investor.gov, which you can find under Financial Tools and Calculators on the landing page where you see the red arrow above. Now, quick refresher on Investing 101. All investments have risk. That is what distinguishes them from money that we put in bank products. but investments tend to have a better chance at a greater long-term return. The risk of investing can be managed or even reduced. Two of the most common strategies to do that are: one, making intelligent decisions based on where you allocate your assets, in other words, what you invest your money in the first place, and two, diversifying, spreading your investment eggs among many baskets so that if one falls and breaks, you are still eating tonight. In investing, the potential for higher return typically comes with higher risk. This chart shows where some of the common saving and investing products fall on that risk and return graph. Think of this yellow arrow as the risk and return line. Look how we move from safer but lower return cash investments like our bank accounts or like the TSP's G fund at the bottom left, up to riskier but potentially higher return stock investments at the top right. Knowing the likely risk and potential return of investments can help you decide what to invest in. We call this process asset allocation. And really, the two most important considerations are your time horizon, how long until you will need the money, and your risk tolerance. How much risk do you want to take on? As Randy noted earlier, generally, the longer you have to invest before you need your money, the more risk you can afford to take on because, generally speaking, a longer time horizon gives you more time to recover if there is a market downturn and you don't need your money right away. As you approach the time period when you will start using your nest egg, most people seek a portfolio that takes on less risk. And so when you look at your TSP investment options, you can allocate your investments among the 5 funds based on your time horizon and risk tolerance, with the safer, lower potential return products on the bottom left, like the G fund, and those riskier, higher potential return products on the right, the 3 stock funds. Of course, in the TSP, you don't have to plan your own asset allocation, although you are certainly welcome to do so. Those life cycle funds are set up to reflect more risk and return seeking with the long time horizon funds like the 2070 fund, mostly stocks, but then the allocations become more conservative as retirement approaches, with the shorter term L-Funds like the 2050 or the 2030 having increasingly larger percentages of treasuries and bonds. Now, in the private sector, these types of funds that automatically adjust are called target date funds because they're designed for investors to begin accessing their money at a certain target date. This automatic transition from a more aggressive, stock-heavy allocation in the earlier decades of your career to a more conservative mix as you approach retirement is what makes the L-Funds unique. Look how the 2060 fund is allocated for a federal employee with a long time horizon. It's nearly all stocks in the early decades of the employee's career, but in later decades, the mix of investments gets increasingly conservative, with G fund and F fund taking up a larger share of the portfolio as you get closer to retirement. And here's a peek at an allocation with a shorter time frame. A 2030 fund where you see that this fund has already converted into a more even mix of the 5 investment funds, with the conservative G and F funds making up more than half of the portfolio as this employee approaches retirement. No matter what you invest in, you should seek to diversify. Spread your eggs among many baskets. Some products that make that easier than others are like mutual funds or the TSP. They tend to spread your investments among multiple companies, sectors, or asset classes in order to reduce the risk of investing. Now, this graphic shows the performance of the stocks in an S&P 500 index fund over a single day. Basically, 500 of the largest publicly traded companies in the United States. Think of this as the C fund in the TSP. If your entire net worth was invested in only a single company shaded red or dropping in value on this particular day, like Apple or Tesla at the top center, you would have lost money on this trading day. But if instead you held shares of the C fund or an S&P 500 index fund, you may have broken even or even posted gains. As you see on this day, other sectors, other stocks did well and were colored green. That's the benefit of diversification. Your exposure to the broader market may limit your losses, allow you to break even, or even post gains. in addition to diversifying, pay attention to fees. It's not a big concern with your TSP funds, which, as Randy mentioned, have very low fees. But if you're investing outside of the TSP, consider fees, because even small fees can cut into your returns. Different investments may have different fees. They have different names like commissions, sales loads, advisory fees, management fees, account fees. And typically, remember that actively managed funds that are trying to beat market indexes will have higher fees than passive funds like index funds. If you plan to invest outside of the TSP, be sure to compare the fees and expenses of those funds. FINRA has a free tool you can use. It's called the Fund Analyzer. You can find it on FINRA's website, FINRA.org. This tool offers information and analysis on over 30,000 mutual funds, exchange-traded funds, or money market funds, including the total expense ratio, which combines all of those fees and tells you what it will cost you to hold those funds over time. Remember that you have options, as Randy noted, if you plan to leave the federal government or the military. You can leave some or all of your money in the TSP, and you can let that investment continue to grow as you move on to your next chapter. Or you can do a tax-free rollover to your new employer's 401k, or roll that over to your own individual retirement account. Now, can you cash it out and spend the money? Many folks consider doing this, but that typically comes with a steep cost. If you're under the age of 59 and a half, you will have to pay whatever taxes you owe on that money, plus you will typically owe an additional 10% penalty, and with some folks doing this, they may only get 50 cents on the dollar. Once you retire and begin the decumulation phase of investing, your next challenge will be making smart decisions on how and when to take money out of your investment accounts. You may want to roll over a retirement account if that makes sense. Of course, you'll always follow the IRS rules if you do so. And at a certain age, Randy mentioned the law will require you to make required minimum distributions, or what are sometimes called RMDs. Basically, we are required to spend down our retirement accounts, and you will want to be strategic about that. The RMD calculator on Investor.gov allows you to determine how much money you will need to take out of your traditional IRA or your 401k in any given year. Investor.gov also has other tools and calculators, including the Social Security Retirement Estimator, the College Savings Calculator, and the aforementioned Compound Interest Calculator and Savings Goal Calculator. Randy mentioned Secure Act 2.0, which did raise the RMD age up to 73. That will go up to 75 by 2033. It also did a few other things. The penalty for failure to take an RMD has been reduced, even to as low as 10%, if you catch the mistake within what they call the correction window, which is generally 2 years. If you happen to change jobs frequently, or you lost track of a retirement plan somewhere along the way, the Department of Labor now has a lost and found database where you can search for your funds. That's at lostandfound.dol.gov. And if you'll turn ages 60 to 63 by the end of the year, I mentioned earlier, the amount you can contribute to a workplace plan like the TSP has gone up to $11,250 in catch-up contributions. Let's talk about scams, because no matter how large our nest egg and regardless of our GS level or salary, scammers are getting increasingly sophisticated, and they're using social media, digital communications, and other techniques, even AI, to try to scam us. Now, the dictionary defines fraud as lying or deceit used to steal someone else's money or property. Here are some red flags of fraud. Most notably, if you hear about investments that are promising high returns but have little or no risk, remember that in investing, the potential for higher returns typically comes with higher risk. So it's a big red flag when you see someone claiming huge results with no risk. Also, be careful when they play on your FOMO, right? Your fear of missing out. Or when they try to get you to act quickly. You want to always take your time and do your own independent research with neutral, unbiased resources. And don't be influenced by celebrities or online testimonials. Those folks are likely being paid to endorse a product that may or may not be right for you. Fraudsters often impersonate organizations or individuals to lure victims into scams. They may impersonate banks or brokers, investment companies, UPS, Amazon, EasyPass, or even tech support to fix a computer problem. Fraudsters may set up an account name, a profile, or a handle designed to mimic a particular individual or firm. They may even pose as the SEC or another government agency. They could call potential victims on the telephone or email and request detailed personal and financial information. Remember, government staff typically will not contact you via phone without initial contact from you. Keep in mind that impersonators may copy or imitate the official SEC seal without authorization. If you're concerned that a communication may be from an imposter, do not use the contact information that they provide. Instead, cross-check with the information on the real company or the real agency's website. Do you ever get a text out of the blue from someone who either just has a greeting or seems to be confusing you for someone else? These are not accidental texts. Instead, they're a deliberate pretext to get you to communicate with a scammer who will then slowly build some trust, perhaps even a friendship or another relationship, and may ultimately lead to an investment pitch or scam of some sort. This is a long con. We call these relationship investment scams. They're willing to communicate for weeks or even months at a time with friendly or romantic banter. Eventually, the scammer will introduce some bogus investment opportunity or some realistic-sounding crisis that requires immediate money from you. And once you realize it's a scam, you'll be out of the money, but you may not be out of the woods because scammers will often sell your contact information to other bad guys who may approach you with bogus offers to recover your funds or get involved in other scams. So don't respond to these texts. Just delete, block, and report. What can you do to protect yourself? Well, first, of course, ignore any contact from senders you don't know, and certainly don't take investment advice from someone who contacts you online, through an app, or through a text message. Do your due diligence. Research any possible investment opportunity. Fiercely protect your personal information like financial account numbers, logins, etc. And if you've already had some communication or made payments like this, by all means, stop communicating now. Do not send good money after bad. Some scammers take advantage of trust that they've gained by being a member of a group, like a church, a veterans group, a book club, or a chat room. Be careful here. You need to check the background of any investment professional before you invest, even if they go to your place of worship or live in your neighborhood or share some common background. Even federal employees can be targeted with a scam. The SEC brought in enforcement action against a group of former brokers in the Atlanta area who were accused of fraudulently inducing federal employees to roll over holdings from their TSP retirement accounts into higher-fee variable annuity products. Notably, the SEC alleged that the company implied it was affiliated with or approved by the federal government and the TSP. A takeaway here: the federal government and the TSP do not endorse or sponsor any particular securities, products, services, firms, or individuals. Don't trust any investment professional who claims to be affiliated with the government, the TSP, or any government retirement plan. And if you have any doubts, contact the appropriate agency directly or contact the SEC at help.sec.gov. If you plan to use an investment professional, like a broker or an investment advisor, one of the best steps you can take to protect yourself is to do a background check on that professional before you send money. You can do that as fast as you can get a Yelp review for the nearest restaurant. Just type the name into the Check Out Your Investment Professional toolbox on Investor.gov. You'll see if they're licensed and registered, and you'll even see if their employment history and any other important disclosures like customer complaints or disciplinary actions. For example, if Jordan Belfort the guy who inspired the Wolf of Wall Street, was trying to sell you investments, you would learn that he has been barred from acting as a broker or an investment advisor and from selling securities or providing investment advice to the public. You can find out if someone is currently registered or licensed and has been suspended, as well as that person's qualifications and employment history. Be sure to exercise good online hygiene. Always pick strong passwords with letters, symbols. Never use the same password for different accounts. Take advantage of what they call multi-factor authentication. In other words, put in your username, put in your password, and then have the company send you that 6-digit code that goes to your cell phone for the final access. Turn on account alerts. And this is important. Update your devices regularly. That means restart your computer at least once a week and always update your phones with the latest software updates. Don't click on links you don't know. Those links can install malware on your device. If you get an offer to invest in something, be careful how you pay. Scammers love to have victims pay with untraceable and irreversible methods like gift cards or sending wires overseas. Once you send that money, it's gone. We have hundreds of alerts on scams that our enforcement division is seeing and ways you can protect yourself. You can sign up to receive these alerts and bulletins on Investor.gov. These are just a few recent examples. And there are many ways to contact the SEC and to stay in touch with us. You can submit questions or investor complaints via help.sec.gov. You can report a suspected scam at sec.gov/TCR. That's tips, complaints, and referrals. And if you have an audience that can benefit from a conversation on saving, investing, or avoiding scams, you can always email us at outreach@sec.gov. That brings our program to a close. Thank you to Randy Urban and the Federal Retirement Thrift Investment Board for your sage counsel today, and thank you to you for your service to the government. Best of luck on your next chapter.